Hello, everyone, and welcome to the third quarter 2020 investment market review. My name is Bob Dunn, president of Novi Wealth Partners. Today, I will be joined by Mario Nardone, our chief investment consultant. Each quarter, we create content that is relevant to all investors and based on science, not speculation. We intend to provide knowledge and guidance, not sensationalized forecasts on future investment outcomes. As fiduciary advisors, our primary goal is to do what is in your best interest. You will not find us chasing the hot stocks or pretending that we know the future. In place of the traditional investment entertainment, we tend to make sense of what is going on today in the investment world and what that means to you. Today, Mario will look at what has happened in the investment world during the past quarter, as well as provide some education and context to what is consuming most of the investment headlines today. I look forward to what you have for us today, Mario. So let's hear it.
All right, thanks, Bob. Glad to be here again, and hope you, your crew, your clients, and your whole community are surviving this strange time in this pandemic. So let me share my screen, go off camera, and get the show on the road.
Sounds good. Thanks, Mario.
Sure. So, as usual, we want to start with a balanced perspective. With COVID-19 still unresolved from a health standpoint, that's probably going to be the major driver to full economic recovery. It almost goes without saying. The sooner that we can get to a vaccine that the world has faith in and that we can get to all corners of the globe, the quicker we can get back to normal. With that being said, there are always positive and negative signals out there in the media and investment entertainment, as you said. I love that term. So on the left side of the screen, we have some of the positive signals that we're observing in the economy. And that is that we have seen different economies who have been able to slow the spread of the virus, have been able to slowly open up, and we've seen economic activity ramp back up as economies open. So that's a good sign for the future when we're able to do that on a more globalized scale. We've also seen reduced cases in COVID-19, as well as reducing the death rate from the virus, which means treatments are getting better. We're getting smarter about preventing the spread of the virus. The medical community is getting better at treating the virus. We even know, the use of ventilators is not quite as widespread as in the beginning, and that's knowledge that we've learned throughout the course of this pandemic. So that's a good thing. On the right side, we see reasons for concern, or probably better stated, just uncertainty, not necessarily concern across the board. But some of those uncertain aspects of what we're looking at are things like, what kind of market volatility will ensue as we get closer to the election, and then, through the election and beyond, regardless of whether we have a new administration or a continuation of the current one. Similarly, will we get more fiscal stimulus? Will we get the stimulus package that most of the economic community, the financial markets, and especially the businesses and people impacted by the virus are very interested in seeing happen? Political gridlock could prevent that from happening. So we're really going to be interested in seeing what happens in Washington. And then specifically as it pertains to our portfolios on the fixed income or bond side of the equation, we have historically low yields, and yields translate to expected rates of return. So trying to figure out how to navigate a low rate of return environment is something that you and I, Bob, definitely have been spending time on, and will probably continue to do so as we move forward.
No doubt, always trying to get the best return for the client.
Absolutely. And on the, along those lines, looking at low yields from Treasury bonds, as you and I and the team have talked about this quarter, is it worth it to keep holding securities when they have such low yields? And to date, the conclusion has been yes. We might question why we have something in the portfolio with an expected return less than 1, but when you actually think about holding something like Treasury bonds as an insurance policy against a potential stock market decline, we look at it sort of as the cost of insurance. So continuing to weigh the pros and cons of investments in our portfolio is something that will continue to be an uncertainty, but something we will keep our finger on the pulse of.
Well, like I've made statements before and we've discussed in the past that at points we may be dissatisfied with an investment that's within our portfolio, but as you just mentioned, it serves a purpose. And many of our clients find that that's a valuable resource to have in their portfolio, even though it's not providing the returns that we would hope to see in long-term perspectives right now.
Absolutely. We'll start our presentation talking a little bit about the election. And you see the headline of our slide here about playing politics hasn't been a good idea. And that is specifically from an investment standpoint. There are certainly investors out there who, almost regardless of their investing experience, still believe that one party or another would be better for the stock market. The 24-hour news outlets, which seem to be migrating to diametrically opposed ends of the political spectrum, is also partially to blame. Nonetheless, if an investor only had money in the market under presidents of one party, their results would have been very disappointing. If you look at the slide on your screen, the left bar represents an investment in 1961 of $10,000. For this investor, they're only putting their money in the market when a Republican is in the White House. And as you can see, over that time period, their investment of $10,000 would only have grown to about $86,000 at the end of last year. If a different investor put $10,000 to work, but only invested under Democratic presidents, their rate of return would have gotten them to $376,000. But an investor that stayed invested, regardless of who was the president, would have turned a $10,000 investment into $3.2 million simply by staying the course. If nothing else, that just shows you the power of compounding and the fallacy of thinking you can time the market or whether or not who's in the White House makes a difference. To break this down into more detail, we have every presidential term from Herbert Hoover during the Great Depression through Donald Trump's presidency through the end of last year. So you could see the rate of return, which to the left means that their term resulted in a negative return for the S&P 500. The bar pointing to the right shows a positive return of the S&P 500. So as you can see, there have only been 4 presidential terms where returns were negative, and those were around the Great Depression and Great Recession. And I'm not sure we can fully blame either of the presidents at that time for any of those periods. There is some evidence that divided governments, which is when the president and Congress are controlled by different parties, have presided over lower economic growth and stock returns, but even they are strongly positive. So that in itself should be nothing to fear. You hear a lot of that in the media today, whether or not we have a clean sweep of the president and Congress and what that's going to do. And yes, that does create a little bit of gridlock and it prevents real policies from getting done. But nonetheless, if you break that down historically, even under divided governments, we still see positive growth, both in economic terms and in the stock market.
I want to just say in these contexts of these, what I'd have to say is capitalism prevails no matter who is presiding. So it's just continue to participate. Sorry, Mario.
No, absolutely. That's a great point. One factor as to why this is the case is what you're just saying is that companies are responsible to their shareholders to make a profit regardless of who's president, regardless of changes in regulation, taxes, tariffs, et cetera. And collectively, this data shows that they've been pretty darn good at it. So I definitely wouldn't be betting against the House based on anything in the political realm. And this chart you're looking at here shows exactly the same information we just looked at, but more so in a cumulative or aggregate fashion. So, again, going back to the Great Depression, this actually takes it one president earlier. If you had put any money to work and let it ride, regardless of who the president was, you would have seen a long-term growth trajectory. So let's take a little bit closer look at how we're doing in our economic recovery. The headline here says a partial recovery, and that really is evident by the slides. If we look at the far left, we see how our various components of our economy were chugging along. And specifically, we're looking at economic activity that's easily tracked. So we understand how New home mortgages are trending. Consumer credit and debit transactions, meaning just general consumption activity. And then we look at some sectors that are predominantly those that were hit more heavily by the pandemic, those that are a little bit more reliant upon social interaction. So you can see that around, in March, a lot of our economic activity, regardless of sector, really fell off a cliff. Most notably, basically 100% decline in, eating out at restaurants, and almost 100% decline in airport travel. And as we've progressed through the pandemic, you've seen a partial recovery in some of those segments, but a full recovery, and actually very strong recovery in new home purchases, right? And part of that is due to low borrowing rates, low mortgage rates, and part of it is due to a migration out of apartment dwelling in big cities and into more, rural settings where people can conduct Zoom meetings like this one, basically anywhere they can get an internet signal. So new home purchases have been strong, but ultimately, when you look at the trend of all of this economic activity, you see that we definitely are not back to where we were pre-pandemic. So now let's start looking at some financial market activity. And let's start with bonds. With an uptick in optimism for a continued rebound and eventual vaccine, investors' appetite for risk showed up in slightly higher returns for corporate bonds during the third quarter. And that's evident by the red and blue bars on your screen. I should say the light red and light blue. So for instance, for the third quarter, you see 1.1% return for short-term corporate bonds, 1.9% return for intermediate-term corporate bonds. As we'll talk about a little bit later, the market's inflation expectation has also been ticking a little bit higher, especially over the third quarter, resulting in decent returns for inflation-protected bonds. Those are reflected by the green bar, showing a 2% return for the quarter. Over longer periods, bonds of all kinds have turned in decent results as investors have sought safe havens, like we talked about earlier, from Treasury bonds, and as they've been seeking out higher yields. Bob, as you mentioned earlier, with low yields in the marketplace, investors have been looking, even moving from cash, which has essentially been earning 0%, being willing to take on a little bit of risk and buying bonds and other yield-oriented securities, pushing their values up.
Yeah, and I'll just, to make some clarification for the viewer, what we're seeing here, I'm assuming, obviously, is the total return associated with the investments. And there's two components of that, and that's the yield. And then also, as interest rates fluctuate, if the interest rates drop, you're going to see an increased return on the fixed income, which, surprising to a lot of us, we continue to see interest rates continue to decline or stay at what we would think rock bottom levels, which have increased the total return on the fixed income side of the portfolio. So is that some of the perspective that we're seeing here with the numbers on this slide? Absolutely.
Yeah. So if you just want to focus on a particular number, let's look at this purple bar right in the middle of your screen showing the 5 to 10 year US Treasury, which is what we would determine or call the intermediate term Treasury bond market. You see a 9.9% return between December 31st and September 30th. And when you consider that at the beginning of the year, the yield on those securities was fairly low, probably in the 1 to 2% range, what you just described is exactly how you arrive at a 10% return on a product that was priced to yield something much less than that. And now let's take a deeper dive into that relationship. So just to reiterate and clarify what Bob just said, one feature of bonds that we have to understand, or that is helpful to understand as investors, is that when prices go up, their yield goes down, and vice versa. Now, this stands to reason, especially when you consider that another name for the bond category is fixed income. In other words, if I have a bond paying a fixed coupon of 5%, but its price goes from $100 to $120, my coupon payment might stay $5, but my rate of return is now closer to 4%, right? So going forward, that 5% coupon bond is now yielding 4% because the price has gone up. So what this graph is showing you is exactly a result of that relationship. The dotted line shows you the Treasury market yield curve, as they call it, from about 7 years ago. And that's somewhat arbitrary, but it's really just chosen to tell the story. The rising value that we just discussed on the previous slide, the 10% Treasury return, is a direct result and an outcome of the downward trend in yields over essentially the past decade. So what that's done is you can almost think about that as receiving future yields today, right? So if I owned this, let's just look at this 10-year Treasury bond as of December 31st, 2013. If I expected to earn a yield to maturity of 3% on that portfolio, if the yield curve doesn't move, that's exactly what's going to happen. I get a 3% return every year until that 10-year bond matures. But because of what's happened in the marketplace, the flight to quality, right? Investors buying up Treasury bonds in an effort to escape risk in other categories, because of a flight to seeking of yield, these Treasury bonds have been bid up in price. So if I was a holder of that bond, the value of the bond has gone up, but the yield going forward has gone down. So over this period, I've gotten a higher rate of return due to the price appreciation of that Treasury bond and a lesser component of that return generated from its yield.
Yeah, bonds are so much more complex than equities. Equities are something that I think is easy to digest on a daily basis. You know, you take a raw product, commodity, and create a new product or deliver a service. And we can all appreciate, you know, Starbucks taking those beans and creating not only a cup of coffee, but then also an environment that we deem pleasurable. So we'll pay a premium for it. In this case, that's all conceptual. You can understand that. Bonds, this sort of invisible movement of the returns that you receive. Sometimes there's a disconnect or hard to wrap our heads around, but thank you for that explanation, Mario.
Yeah, absolutely. Always happy to help educate. So if the questions are out there in your audience, don't hesitate to lob them our way. I'm a mathematician at heart, and I'm probably the only, geek on or listening to this call that actually loves to talk about bonds. So always happy to answer those questions.
Awesome.
So on a going forward basis, we talked about this in the earliest part of the presentation. You might be asking questions, well, why should we own a 10-year bond that's only earning 69 basis points or 0.69% yield going forward? And, again, we've debated this, and I would say that the prudent approach is the one that we continue to take, and that is that Treasury bonds are among the best investments to hold in a period where the stock market declines. So, in one way, you might say it's the cost of insurance, but in this particular instance, we're actually being paid something to have insurance. We're not paying for insurance. We're receiving 0.69% to hold a security that's going to protect us in an unforeseeable environment. We don't have a big chunk of our portfolio in this type of security, but we do have something so that it zigs when the rest of the portfolio zags. Perfect. Now, that being said, the rest of our bond portfolio is positioned in a way that achieves a better rate of return or attempts to achieve a better rate of return. And we do so by diversifying out of U.S. Treasuries and holding things like U.S. corporate bonds. So in other words, bonds issued by companies like Starbucks, but also having some securities, some bonds that are issued by entities outside the U.S. where their home yield curves are, different shapes and at different rates than the ones here in the U.S. So one of the reasons why low yields shouldn't necessarily be that scary or unpalatable is that inflation is so low. if bonds were yielding 1% and inflation was 4%, then we'd be losing a lot more in terms of purchasing power the longer we hold those bonds. But as this slide shows, and if you focus your attention at the far right, you see that inflation really has been low and steady for quite some time, and the global slowdown has further dampened it. If you look at this bar or this inset here, you see that CPI, which is Consumer Price Index, regardless of whether you include food or energy, that's really the difference between headline and core. You see inflation, meaning the average annual increase in the prices of a basket of goods. And I don't want to get too complicated in there, but it includes a lot of things, including energy prices, food prices, the price of a movie ticket, the price to rent an apartment. All of those things collectively are being tracked. And we see that the August numbers show us that on a year-over-year basis, the average increase in prices has been between 1.3 and 1.7, depending on whether you include food and energy. Now you see that, energy, meaning, essentially the price of a barrel of oil, has declined in value over the last year. So we actually have a decrease in transportation costs. That is a direct result of a significant decline in airline travel, significant decline of commerce, basically requiring cargo ships and cargo carrying airplanes and things like that. So it stands to reason that when the economy kicks back up again, there probably should be an expected uptick in inflation. And that's partially the rationale, what I mentioned earlier. The economy is already starting to see some of that, or started to expect some of that. And that's why things like inflation protected bonds have started to come into favor a little bit. On top of that, for those of you that follow the financial headlines, and in particular the Federal Reserve, there was a revisement in the Fed's strategy, going all the way back to the Great Recession and the Ben Bernanke years. The Fed has had what we've called a dual mandate, basically to keep inflation around 2% and to keep unemployment as low as possible. Well, now with where we stand, given the COVID pandemic, the Fed has removed its mandate of targeting a 2% inflation rate, but instead replaced that with what they're calling inflation targeting, meaning that they want to have an average inflation rate of around 2%. The implication there is that instead of expecting inflation to be anchored around 2%, it means that if inflation is currently running at 1.3, right, let's say that is the case for 3 years. Well, in order to get an average inflation rate of 2%, the Fed may let inflation run to 3% for 3 years to get that 2% average. So the idea that we might expect a little bit more inflation going forward is something we should think about as consumers, but also, again, Bob and the team and I are constantly thinking about in terms of our portfolio. And nonetheless, there's also let's call it a humanitarian aspect that, part of this policy is to get more people back to work. Let's get those low income earners back to work, regardless of what industry they're in. We do know that lower income earners spend a higher proportion of their income, which is expected to boost the economy if those folks get back to work. Now let's get to the topic that everybody always wants to talk about, and that is the stock market. During the third quarter, the S&P 500 returned to its pre-pandemic peak, specifically in August of this year. The red line on this graph shows how many days it took to go from its peak, so pre-pandemic peak, to its bear market trough, or its lowest position, back to its peak. And it shows that it took a mere 126 trading days. The next fastest recovery on record was back in the 60s, when it took over a year. This is 310 trading days. So it went from February of 66 to May of 67. So over a year was the next fastest that the US stock market has ever recovered from a bear market. Now, to me, the most important takeaway is who would have predicted this? If somebody told you back in February that we would still be wearing masks and the president of the United States would have COVID in October, would you guess that stocks would have rebounded that fast? Probably not.
I'm
So
not getting
again,
in that game, Mario. Sorry.
not a game I play either. I'm glad you teed that up early in the presentation. And that's just, further proof that timing the market is difficult, and, really sticking to a systematic investment approach, which includes rebalancing back to your targets in a disciplined way, is always the best approach. Now, the dark underbelly of that story is shown on this slide. So we talked about a fast recovery, but there is a story of the haves and the have-nots. And I'd like to just point out that we often talk about the market, and I've used air quotes there, or the S&P 500 as if it's one homogeneous thing. And it really isn't. And this year's experience makes it very clear that it's not. So what you're looking at here is the rate of return of the S&P 500 at the left through August 31st. Now, I know this, it's obviously a lot has changed since then, but the point is still true. The S&P 500 was up about 10% year to date through August 31st. But if you look at just the top 5 stocks in the S&P 500, you see a substantially better rate of return. And if you look at the other 495 stocks in the index, you actually see their return is negative. Those 5 stocks, the largest in the market, Apple, Microsoft, Amazon, Facebook, and Google's parent Alphabet, are the ones that drove the S&P 500. Without those stocks, the market is negative. Now, this isn't, just a sort of shot in the dark kind of story. There is a good reason why these stocks have done well, and that is that their products and services are exactly the kinds that are needed in a situation where people are shopping from home, in the case of Amazon, using a lot more computer technology, in the case of Microsoft and Apple, and using the internet a lot more for communication and social networking, like Facebook and to an extent Google as well. So again, the key takeaway here is that the S&P 500 is, actually another key takeaway, let's put it this way, is not really a great benchmark for somebody who's invested in a diversified portfolio. Diversified portfolios not just own the other 495 stocks in the S&P 500, but they own stocks not in the S&P 500, smaller companies. There's over 3,000 stocks in the market. And, obviously many of them aren't in the S&P 500, not to mention investments outside the US stock market entirely.
I just want to take one moment on that, and I may be interjecting too early in regards to the next slide I saw there, but this is not an indication to buy those top 5 stocks. If anything, those top 5 stocks are probably, in my perspective, expensive at this point, because the expectations on future returns are so high and people have been purchasing them, and the price of these positions have increased so significantly. I don't want to get into the nuances of it, but this is where discipline and having a relationship with someone that will keep you in your seat and not chase what is particularly a hot or a desirable investment at any given time. We want to, focus on goals, and Mario's going to touch on that, I think, towards the end as well. But this is a very enticing and an area where people may want to chase after those 5 stocks at this point. So there's a lot more I could say about predictability and the opportunity to maybe pick these 5 stocks before it happens. And there's some behavioral elements that we'll talk about, Monday morning quarterbacking and other presentations and stuff. But it's great that the stock market is still climbing like it is. And those that are in the S&P 500, having some domestic allocation, did have a positive return even during this hectic and crazy 2020 that I think many of us would like to potentially move beyond. So,
yep, great point. And it is worth pointing out that our portfolios do have and have had, a position in these stocks. We haven't overloaded on them, but we are participating, and we're participating in a prudent, disciplined kind of way. So great points. maybe just to look at the situation a little bit differently. So let's expand beyond just a handful of stocks and look at the market from a sector perspective. And we can, again, just digest and dissect what has happened throughout the year. Now, this slide is through September. So you see in the middle, towards the middle of your page, the S&P 500's return year to date through the end of September was about 6%. And this slide shows you, again, the haves and the have-nots. Online retail, Amazon, right? The sector return is 60%. Home improvement, lots of people buying, doing home renovations, going to shop, shopping at Home Depot, hopefully socially distancing, or maybe even ordering online. Home improvement stocks up 33%. Technology stocks up 29%. You get where I'm going. Groceries, right? Of course, grocery stocks are going to be up. We can't eat out, so we're cooking a lot more at home. So those are the sectors that have done fairly well, and they have been boosting the market. However, if you look at the other side of the equation, no explanation needed. Energy stocks, we already talked about. Airlines, I was actually surprised to hear that airlines are operating around 50% of pre-pandemic levels. I know that my airline travel has dropped off 100%, but somebody's out there traveling, supposedly, but nonetheless, their stocks have been pretty beaten down. Hotels, resorts, and cruise lines down 45%. So clearly, these industries are really in need of a shot in the arm, literally and figuratively. The vaccine will certainly turn the tide on these sectors. Now, a more common or familiar way to break down the stock market returns is by the size of the company and whether they exhibit characteristics of a value or growth stock. We often refer to this as the style boxes, right? And just for definitions, we'll kind of go through this every quarter, but just to remind folks or educate folks that are tuning in for the first time, that a value stock is one that is trading at a discount to some metric of its fundamental value. We could use earnings. You've heard the term PE, or price to earnings, or we can use book value. So in other words, what is the accounting value of all of a company's assets, and what is its price relative to that book value? Those would be value stocks if they're trading at a discount. Growth stocks are those that, an investor would hold them despite their price, because they expect these stocks to continue to be able to grow their revenue well into the future. And investors are less worried about paying a high price. So if you actually consider that the technology stocks and stocks that have benefited during COVID are all really, in the domain of large cap growth investments, it's not a surprise that you see this lime green bar towering above the other parts of the market. So hopefully the theme is resonating here, right? That it's not that the market as a whole has survived or has thrived in this particular environment. It's really just a handful of stocks. And whether you look at the stocks individually, whether you look at the sectors that they occupy, or whether you look at the size and style category that they occupy, that's the true story. It's not a size or style story. It's not it could be maybe a sector story, but it truly is just a function of how you categorize those particular companies that have done well. Now, again, going back to what Bob said, we certainly don't want to chase the best returning sector. And in fact, we want to continue to be disciplined. And as the portion of our portfolio that holds this type of investment does well, we're going to be continually trimming our profits and rebalancing into other segments of the market that haven't done well, that we would expect to come back to life when the economy does as well. And turning outside the US, we're looking at different international sectors on this slide, or international segments of the global stock market. The left side of the screen shows you that the quarter was positive, especially for smaller companies and especially for emerging market stocks. Year to date, the numbers are down. So if we think about that, compared to the US market as a whole, which was driven by those technology-oriented names, outside the US, they really don't have those kinds of technology stocks. Outside the US, you tend to have more traditional markets, industrials, financial companies that tend to be more tied to the economic cycle. in particular, the global economic cycle. So it stands to reason that as the economy slowed down, these more traditional, old school economies, stock markets really haven't done quite as well. And part of the reason for decent non-US returns in the third quarter is a drop in the value of the dollar. And that's the bottom graph here. Basically, what you're looking at is the value of the dollar relative to a basket of other currencies as calculated by the Wall Street Journal. So you see that there's a general downward trajectory from the beginning of the quarter to the end. Now, it might sound counterintuitive that a decline in the dollar resulted in strong returns outside the US, but that's exactly what happens. When we buy a security domiciled elsewhere, we're essentially trading in our dollars and buying something that's valued in another currency. So all else equal, even if there is no change in the value of that foreign stock, if we're going to sell that stock and translate our investment back into dollars, we're going to be able to buy more of those depreciated dollars at the end of our holding period. So as you can see on the title of this slide, the opposite of the title, a strong dollar is good for U.S. consumers because it allows us to buy more goods that are created in other countries and other currencies, but it's bad for owners of non-U.S. investments because of the opposite of what I just described. The top part of the slide here shows you the general trend of the dollar over the last 10 years, which you see has been very positive. So that has been good for U.S. consumers. When we go to Home Depot, we go to Walmart, or if we order off Amazon, items that are either made overseas or have components that are made overseas, that it has played into our favor that we've had a rise in the value of the dollar. But the opposite could then be true, which also plays into why you want to have non-dollar denominated investments, because it can serve as a hedge against our dollar-based consumption.
I think one of the biggest takeaways, and maybe you're going to touch on this here, is that, at one point, I remember years back, there was talk about how even foreign investments and domestic U.S. investments were so closely tied in this global economy at this point. Was there even the necessity to have a broadly diversified portfolio? And I think we're seeing some extremes right now in differences in returns between the different asset classes, as well as the domestic versus foreign markets. And like we were talking about before, capitalism still works. Different countries have different policies and procedures that they follow, but we all go through different cycles. And like you were talking about currency, whether it's policies, based on COVID or whatever's going on in the global economy, there are going to be differences in outcomes, and we cannot predict when they're going to happen. There are too many variables associated with it. It's not the same as either running a business or a household where you have some control over those elements and the outcomes that transpire. Here, there are so many things outside of our control and unknown, that trying to maneuver from one area to the other with the expectation that you will get in front of any rise in the stock market or decline is actually going to be more likely to be detrimental to your outcomes, investment outcomes, than help them. So I just wanted to add that context, because there's been a lot of volatility in the markets and uncertainty, and that's driven some of these the differences in the returns in different areas. So maybe this is what you're going to touch on here now, showing the Cowan chart. But anyway, I'll shift it back to you at this point, Mario.
Yeah, no, that's that great segue, and definitely part of why we want to show this slide. I like to show this slide just to, as sort of evidence that the market and a lot of, some investors have short memories. If you look at the far right side of the page, right, let's continue that conversation about U.S. large cap equity, meaning large companies here in the U.S. It's hard to remember a period where large cap stocks haven't been the best game in town, right? You look at the last, 7 years, large cap equity was in the top half of this page. But, there was a period of 11 years between 2002 and 2012 where non-US stocks, this gray bar, and I'm not going to drive your eyes crazy by pointing them all out, but the gray bar showing non-US stocks outperforming large cap occurred 8 out of those 11 times, right? So to think that the large cap stock market or portion of the stock market is going to continue to be the best performer going forward is just hard for me to swallow, and definitely not a game you want to play, because the implications of getting it wrong and continuing to be behind the 8 ball chasing the most recent hot performer just has proven to be detrimental in the long run. So basically our strategy is to be as diversified as possible, own as many different types of investments as possible, so that you're never just owning the worst thing, but you have to accept the fact that you're not concentrated in the best performing part of the market. And then lastly, this slide really drives it all home. It shows you the benefits of spending time in the markets, not timing the markets. And basically it shows you that as you extend your holding period, the chances of a negative return diminish to essentially a rounding error of 0%. So essentially, if you look at this 1-year pie chart, you see that 74% of 1-year periods since the Great Depression, your 1-year return in the market would have been positive, and only 26% of the time would you have had a negative return. Over any rolling 5-year period, the chances of being negative are diminished to 11%. Over 10 years, they're diminished to 6%. Now, it must be acknowledged that 6% of the time, you could have a 10-year return that's negative. So we should be willing to accept that. But once you extend your holding period to 15 years, then there's almost, no or none or almost no period of time when you would expect a negative return from the stock market. So I'll just, this is a slide that we close out with all the time. We try to pick a different bullet point to focus on. And I would say this time, since the conversation hinged so much on diversification, let's focus on the third one from the bottom, where we talk about investing broadly and globally. We might have picked this one last quarter. I don't remember. But it's so important right now that we stay diversified. We don't try to chase the hot performer. We make sure we have our clients' risk tolerance in mind when we choose the overall asset allocation. In other words, how much of your portfolio should be in stocks, and then diversify in as broad and global a manner as possible. All the other bullet points are important too. So we don't want to forget about those, but definitely focus on that investment one in this hectic time, as Bob said. Yep. So appreciate your attention. Those are my prepared remarks. Kick it back to Bob. I'll stop sharing. We'll close it out on video.
Yeah, Mario, I mean, first, I want to thank you. It's great to have you, as part of our team here to keeping an eye on these elements and continually finding ways to say, digest and distill these complex topics. And this is obviously the quarter assessment of what's transpired, but we hope to continue to deliver valuable content like this that's not sensationalized, that's focusing on the elements that you can control. So I'm appreciative that we have you to remain independent and not, getting bombarded with information. So, that's going to drive people in every different direction. And one last note on that last slide that you said, we are constantly reminding our, the people that we work for and deliver investment advice to focus on the things you can control. And that last slide was talking about that. And part of, Mario helps us with the research and recommendations around our investment portfolios. And our thing is to continually keep people on the right track to fulfilling their goals. And education is a huge part of that. And the other part is implementation. So we spend so much time internally at Novi focusing on how we're going to implement the recommendations and guidance that are given to us to ensure that the outcomes that are possible are then that flow through to the end client. So Mario, again, thank you for these helpful insights, and it's always appreciated, and I enjoy the time that I get to spend with you talking about these matters.
Yeah, it's a pleasure, and we respect and are thankful for your partnership. And like I said earlier, always happy to jump on a phone call whenever questions arise, or whenever we just want to have a conversation about these pretty complex topics.
Sounds good, Mario. Again, appreciate it, and see you the next time around. Be well.
Okay. All right.
Thanks. Bye-bye.
See you.